Good morning. Welcome to Financial Accounting for SS1 Week 4. I want to appreciate our SS1 students and their parents. You have been cooperating in your assignment, and I want you to put more effort so that we can all be at the same page. Now, for some time now, we'll be looking at statement of accounts. We have looked at trading, profit and loss account. We have looked at all the items that are needed to compute that account and how the account is being prepared. I've even done a classwork on that, and I'm happy and I'm sure that we are all following. Today we'll be moving to the next book of account, which is balance sheet, preparation of balance sheet. Now, the specific objective at the end of this lesson, I should be able to 1. List items in balance sheet. 2. Determine the value of an asset. 3. Determine balance sheet total. We would go to determine balance sheet total, or determine the value of an asset. We're going to determine all the items that are in the balance sheet. Is that okay? But we will not be left out at looking at what a balance sheet is. Okay, just as we have discussed earlier, that a balance sheet is an account that you prepare to check the value of the company at a specific date. Now, these are the items that will be seen in the balance sheet, just as we have been seeing briefly at the balance sheet format. That is where we actually see how the items are placed side by side and all of that. But we'll try as much as possible to explain the pictorial view of what a balance sheet should look like in the theoretical form, so that at every point you are asked, you should be able to explain what it is, so that you don't just have the format in your head without understanding how to put them in writing when you are asked to state any of them or to place any of them in where they are supposed to be. Now, we should be looking at the items in the balance sheet. Most of these items varies from visible and invisible items, but must be able to determine its value and attribute financial implication to them. Now, when we say items are visible and invisible, just the name implies there are items in the balance sheet that you can see, that you can touch, that you can feel. You also have some that you may not be able to touch. You can't see it, you cannot feel it with your hands, you can't touch it, you cannot understand their existence, but they are there. Some may be subjective in nature, like goodwill, but must have a financial value before it can enter the books of accounts. Now, when the cost or the total cost of a particular asset is, say, 200,000, and that asset, or let's say machinery, is located somewhere, is located inside a building where it is used for production and all of that, and you want to sell that asset, you now say, no, I cannot sell that asset for anything less than 200,000. They'll begin to ask you why. You say, the name that this asset has made because of the level of production, because everybody know that the secret behind our good product is this asset. So automatically the asset has attributed a goodwill to itself. Or you want to sell a company or an establishment, you look at every item they have in that organization, put together, current market values. You say it is 5 million. Say, okay, how much will it sell this organization? Say, I'm not selling for 5 million because it has made good name. It has a brand name. That brand name that is bringing the negotiation power between the buyer and the seller is what we call the goodwill. Is that okay? So in the process, you will understand more about this goodwill. All right, let's go. Okay, now let me classify assets for you now. The items in the balance sheet. We have assets, we have liabilities, and we have capital, just as we have it on this table. We have assets that are fixed. We have assets that are current. Now, this fixed asset is what they now call non-current assets. Machinery, building, motor vehicle, goodwill, furniture. There are a lot of them. All those items that the company own, it is used for the running of the business. They are not held for sale in the ordinary course of business, but that does not mean that they cannot be disposed. You can sell them, especially when they are obsolete, when they are no longer useful, or they cannot perform to its maximum capacity, or you just need to replace it for some other reasons. So you can decide to dispose them off, but that is not what you are selling. Okay, like in a bakery, for example, they will have machine, they will have oven, they will have mixer and all of that. But those mixer, those oven are not what they are selling. Those become their assets. But a company that is into importation of oven and mixers, those oven and mixers will not be their assets. Rather, those will become their stock, because that is what they sell. So you discover that what determines what is fixed asset or what is not actually have to do with the organization itself and what they do. Is that okay now? All right. Now, for current asset, we have stock, we have debtors, what they call receivables, we have cash, we have bank, we have prepaid expenses, and all of that. Now, let me quickly look at explain this stock for you. Stock are divided into three forms. We have the raw materials, we have work in progress, and we have finished goods. So any of these stock that are in this form, as at the date that the books are prepared, are summed up together to form this stock. So there is no need of separating the stock and say, okay, this one is raw materials, still in the raw form, this is work in progress, and this is finished goods. No, all of them are put together to form your total stock. So what is important is, how do you now value it? But I'm not sure our syllabus cover that point, the valuation of stock. But if it is, we'll still go to look at it. Is that okay? All right. Now, liabilities. Liabilities are also divided into two. We have the long-term liabilities and the short-term liabilities. Now, the one we call the long-term liabilities, by mere definition, we'll say that those liabilities that the company is not expected to redeem or to pay back within a year, those are the one we refer to as long term, like bonds, like loan notes, like debentures, like debt. Those are long term liabilities. Now, when we say short term, like creditors, acquire expenses, like overdraft, like unearned revenues. Is that okay? All those ones are our liabilities. Now, we don't want us to buttress so much on these liabilities, but I want to quickly bring this to your notice. If you have a debenture, let's say 5 years debenture, redeemable, it will be redeemed in 5 years time. And now, if you are in the fifth year, the year you are going to redeem it, by definition, that item is no longer a long-term item, because it will only stay for 1 year and is redeemed. So such item, or paid off, such item will be moved from long term to short term in the year it is redeemed or in the year it is paid. Is that okay? So I just want you to take note of that. Then you have capital, you have startup fund, you have drawings. Okay, I tried to explain drawings what we're solving, what we're looking at the balance sheet itself. We're looking at balance sheet itself. I told you that drawings are those expenses that are made by the owners of the company. They are not related to the business. They are not related to the business. We call them personal expenses, because the business is on stand, is a legal entity. It can sue and be sued. It's an artificial human being. It's assumed that they have their own right to run their own course by themselves. So any other thing that does not relate to that the running of the business becomes drawings, so it is deducted. We refer it as a less from the amount contributed to the fund that was contributed. Now we also have retained earnings. Retained earnings will form part of your capital because your capital will grow with time. When you make profit, those profit that are not shared, distributed to shareholders, you add it for, they call it plowback fund. When you are applying back your fund, you are taking your part of your profit and say, okay, I want to reinvest this into the business. It become your retained earnings, so it will increase your capital. All of that form your equity finance. Now, the accounting equation. We have said earlier that total assets is equals total liabilities plus total finance or equity finance. So when we put all of these things together, all of this will make total asset. So when we see the format, you see how they are placed side by side. You have assets on one side, you have liabilities and equity finance on the other side. So when you add up this side and add up this side, they must be equal, because whatever you raise from investors, from your contribution, from your borrowings, from the ones you get to pay, when you put all of them together, they should be able to form your asset. So let your asset be able to finance all of this debt. So they must be equal. One side should not be more than the other side. Is that okay? All right. Now, how do we determine the value of an asset? When determining the value of an asset, you must first recognize the invoice price. First invoice price. Then add up all other costs to bring that asset to use at a stipulated place where values can be enjoyed. Now, if you are buying an asset in Ghana, for example, after purchasing, you have your invoice price. Let's say you have converted the money to naira, you say 5,000 cost of asset. You need to transport the asset to Nigeria. When you, after transportation, you need to install your installation cost, your transportation cost. You cannot write it off against your profit and loss account. No. Rather, you are summing it up to part of the cost of that asset. All of them determine the value of the asset. All of that, when you put them together, it form the value of the asset. So you say that value of an asset is the invoice price plus any other cost to bring the asset to use. To bring the asset to use. Before an asset can be ready for use, it must be transported and it must be installed. Is that okay? Now, there are other costs that may be coming in that will look as if they are part of it. For example, the cost you use to train somebody who will operate the machine. You cannot add that, because the cost of training, the usage of the asset will not remove the training from the person completely. So if you charge it against the person, when you now buy another asset that the person can also operate, so which one will you not charge against that? So that is why every other one that you distribute or you need to allocate, that you know that the experience will not end up with that particular machine, you don't need to add it. Is that okay? But after this slide, probably we're going to look at an example to actually see what relevant cost is and what relevant cost with the costs that are not relevant when it comes to valuation of an asset. Is that okay? Or determine the value of an asset. All right. Assets acquired and not put in use cannot be captured in the books of accounts of an organization. When you buy an asset, it's still in the leather. You have not opened it, still in the carton the way you bought it. You cannot put that asset in your books because it's not generating income. You are not using it. There is no inflow. There is no inflow. So when we are talking about matching concept, we are saying that income must be matched, or expenses that are incurred must be matched against the income that are generated from the usage or from those expenses that from the sales. So you match every expenses against the sales that comes out from such expenses. So you cannot match the cost of an asset or depreciation of an asset that have not been used against sales generated by another machine. Is that okay? All right. The value of an asset does not remain the same over time, but can reduce in value for the following reasons. Now, when you buy an asset, we don't expect that the value will remain the same. No, it will not remain the same. Values must change. Value of that asset must change because the asset is put in use. All right. Now let's look at some of the reasons. Okay, before we go there, let's look at this classwork. Now, the classwork, the question is ascertain the value of the asset as stated below. Now, this is the asset. A motor vehicle was purchased for 50,000 and the cost of clearing was 10,000. Our registration was 7,000. If the price to issue license to the driver is 3,000, what is the book value of the motor vehicle? That's one. Number two, what will be the value of the vehicle after 2 years if the lifespan is for 5 years using straight line method and assume no residual value? So I'm going to explain this. I'm going to explain this second part as we begin to look at the solution. All right, now these are the relevant costs: invoice price, clearing cost, and registration cost. When you add up together, you have 67,000. Is that okay? License fee of 3,000 for a driver is irrelevant because that is not the only vehicle the driver will drive with that license. Is that okay? So it is irrelevant. Now the second part. Now when we are calculating depreciation, okay, I know I've not told you about depreciation, but let's just quickly look at this because I needed to bring this in so that we can complete that question. Because we are calculating value of an asset. Just as I said, when an asset is depreciated, the value will reduce. Now, cost of assets using straight line method, cost of assets minus residual value divide by useful life. The asset you calculated, we said is 67,000. And the question say assume no residual value. That means minus 0 divide by 5, which is 5 years. When you divide, you get 13,400 per year. Please press your calculator and you'll see 13,500 per year. Value after 2 years will be cost, which is 67,000. Depreciation for 2 years, which is 13,400 times 2, give you 26,800. So when you less 26,800 from 67,000, you have 40,200. Is that okay? You have 40,200. All right. So that is how we do straight line method. There are other methods of depreciation, but we are going to look at it in our subsequent class. Now let me just quickly give you this before we end the class for today. Now, reasons assets reduce in value. We have depreciation, we have depletion, we have irrelevance as a result of technological advancement, or you can also call it obsolete. I think they are more or less the same. Then asset can also increase in value for singular reason, revaluation. When you revalue an asset, please, we are going to stop here. In our next class, we are going to look at what is depreciation and every other thing that will come up in the course of our class. All right. Then also we'll look at our specific objective, and we'll see that we have been able to look at what a balance sheet, the items in the balance sheet, have been able to determine the value of an asset. So when we look at depreciation, then we'll determine the value of a balance sheet total. To determine the complete balance sheet total. Is that okay? Thank you so much, and God bless you, and we hope to see you again in our next class. Stay safe, read your books, copy your notes, and get prepared for the calculation on the computation of balance sheet. That's why I'm going to determine the balance sheet totals. Is that okay? All right. Have a nice day, and God bless you. My name is Victor. Thank you. Bye.